Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to calculate W-2 wage income. So, some back to the basics here tonight. We'll get started here in just a moment. Give us just a second to go live here on all the different platforms. Appreciate everybody tuning in nice and early. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. You can drop any questions you have in the chat as you tune in as well. And hope everybody's having a great week so far. Great topic to kick off the week here of going back to some basic but important fundamentals here. All right, looks like we're live on all the platforms, so we'll go ahead and get started. What we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat. And you can drop any questions you have in the chat for Jose as well as we go through the presentation here. But we'll go ahead and get it started.
All right. Good evening, everybody. Thank you for joining us for tonight's training. Like Kyle said, getting back to the basics here, but we are seeing an increase in our agency loans, especially a lot of the full doc type loans. We're seeing a lot of FHA purchase loans come through the pipeline as well. So definitely never good a time as now to get back to the basics, make sure we're calculating those full doc files properly, especially our W-2 borrowers. So, how to calculate W-2 wage income. Now, we're going to break it down because wages can come from a lot of places and you're still going to get a W-2, right? So, we're going to go beyond the cookie cutter type of scenario here. And let's break it down. What are the types of W-2 wage income, right? As opposed to some of the other income types that we have discussed in the past, right? Like non employment type income. W-2 wage income is just the opposite. This is from a job, right? This is not from self employment. This is not from retirement. This is not pension plans. This is not interest income. This is earnings from working, right? You're an employee and your employer reports the earnings that they pay to you via Form W-2. And most importantly, on a W-2 income type job, the employer withholds the payroll taxes, right? If not, then it's not a W-2. It's probably a 1099. That's a gross income, and the borrower is responsible for their payroll taxes. And as with all W-2 income type jobs, we analyze the borrower's income based on the gross income pre-tax, right? The pre-tax income. Sometimes borrowers, when we're asking them what their income is, the borrowers tend to report um, their net income because that's what they look at to make the payments. But we analyze it based on their pre-tax income. So then our W-2 borrowers could be salaried, right? Where they have a set salary and it's just divided by however many pay periods they get paid in, but it should be the same amount regardless of if they work more or they work less time. It is set. So if they get paid once a month, right, then their income is going to be their annual salary divided by 12. If they get paid twice a month, right, that's 24 pay periods, it would be their income, annual income divided by 24, and then times two to get the monthly. And then if they get paid bi-weekly, then it's 26, right? So twice a month, it's 24 pay periods. Uh, if they get paid every 2 weeks, it's 26 pay periods. So that's one of the key things that sometimes people make a mistake. However, don't just rely on looking, as we're going to discuss in a minute, don't just rely on looking at what their base pay is, assuming that they've worked all the time that they should have worked in the year, assuming that even that salaried person didn't take a sabbatical or something where they just took some unpaid leave so that they could do something else, or maybe they had maternity leave for or paternity leave, right? And they're getting paid. They got paid a reduced amount throughout the year. So we always have to look at the year to date income, which I'm going to break that down in a little bit. That's the main gist of this presentation as we move on. And then we have commission. So W-2 income can be salaried, can be hourly, or can be commission, where the individual is paid by production or paid per job, but they still get a W-2, right? And you just have to calculate the income differently based on past performance, all right, because that's how it is. It's going to be averaging. Maybe you have a 1 year finding or a 1 year income program that you're selecting. Maybe you have a 2 year findings or a 2 year income program on non-QM that you're selecting because it's better pricing, right? But it's still W-2 income. It just happens to be commission. And that's a confusion, causes confusion sometimes, right? Because you see somebody that is commission and you assume that that's like a whole different ball game. Well, it's variable income is what it is, but it's still W-2 wage income. And as always, on the salaried and on the hourly income types, you always have to take into consideration variable income, especially for salaried borrowers. You're looking at bonuses, really, because they don't have overtime, right? But they do have and it doesn't vary depending on the time that they work, but they do have bonuses. Bonuses may be applicable. And on your hourly worker, definitely you have to look at that year to date because they could be working different hours, different weeks. They could have some time off, again, like I mentioned, that they didn't get paid for. And that's going to mess up your calculations if you simply go to the pay stub and say, oh, yeah, they work 40 hours a week times $20 an hour. They make $800 a week time. And oh, yeah, on their pay period, they get paid every 2 weeks. So I'm going to multiply that times 26, divide by 12, and I'm going to get my monthly income. But you didn't look at the year to date, taking into consideration factors like, working less hours, a raise, taking time off. And that's why I break that down here in the challenges that are faced with W-2 income verification, right? Even in a W-2 income file, downward trending income is a problem, right? Especially if you're looking at a borrower where you're looking at the 2 year income because you got a finding for 2 years and now you realize that the current income is 40%, 50% lower than it was last year. That could be a serious issue that's definitely going to have to be explained, and especially going to be an issue if your borrower is hourly. Now maybe they're getting a lot less hours, and that trend could be continuing. Maybe the business is having issues, right? They're in a retrenchment mode, cutting back on everything. Are they going to have more cutbacks next year? Those are all things that an underwriter is probably going to ask you to document. But it especially poses an issue when you have a variable income component that makes up a good amount of their income for the year, like overtime. I've seen some borrowers, and this is, let's say, especially so with nurses, right? Nurses tend to have the most complicated pay stub of our W-2 borrowers. There's all different types of entries in the pay stubs, and then all different types of overtime, where a lot of times the overtime income of a nurse year to date is greater than their base income, right? So you have to be very careful on how you document that, which we'll be providing some solutions in the coming slides. But it's very important to note that when you have a downward trending income, you cannot average the higher prior income with the lower current income when a 2 year average is required. So, what do I mean by that? Well, assuming 2022 the borrower had $100,000 in overtime. 2023 the borrower had $25,000 in overtime. Now you're going to see a year to date overtime figure, hopefully, on the pay stub as well, so that you can even use the overtime. But at that point, you're going to have to use that 2023 overtime only, because that's the lower of the two figures. You can't average the higher prior with the higher current. And then your current overtime has not yet been reported to the IRS, so you're probably not going to be able to add that to the mix to bump up your average. So you're almost going to be stuck unless there's some seriously good documentation in the written verification of employment, where you get some nice remarks from the employer that, yeah, the reason why overtime was lower in 2023 was because of X. Maybe they had a difference in their how they calculated payroll or how they set it up. But now 2024, we're back to now, how we were before. And if you have a year to date, 2024 that's substantially higher than 2023, then you may be able to document and throwing in the monthly average, like a weighted average of the year to date, into the mix to help your overtime. But the gist here is that you cannot average the higher prior with the lower current and have that figure. In other words, 125,000 divided by 2 is what, 62,500. That's much higher than 25,000, which is what it would be, looking at the scenario I just pointed out. Another challenge is that the documentation must support a history of receipt and the amount, frequency, and duration of the income type. Again, especially important with variable income, where a minimum history of 2 years is recommended. And this is also going to come into play, with continuity and the trend. But here we're talking about, is it every 2 weeks that you're getting that bonus? Is it every 3 months? Is that something that's going to continue, right? Because they put that remark, you can ask them, the employer, to put that remark on a written VOE when it's actually completed by a human being. Poses an issue where you need then to find workarounds, because most of the time now those written verifications of employment are not completed by a human being, in which case you may be able to reach out to their payroll or human resources and tell them why you need somebody in HR actually to complete the form, because you need that comment, or maybe they're willing to write a letter on their company letterhead from human resources stating when they received the raise, or why the variation to the income, to the frequency, duration, and amount of the income. And then we're talking about continuity of the income, right? Is it the same as last year? And this is why it's so important to use the year to date figures on the pay stubs and not the W-2s. You don't really average the 2022 and 2023 W-2 income along with the pay stubs for the current year to date, because the pay stubs current year to date are what's really going to determine our borrower's current income situation. However, I will state there's an exception to this where you average out the prior 2 years W-2s and do not use the year-to-date pay stubs. And we just recently encountered this situation. That's why it's so fresh in my mind, is when you have a borrower that's employed by a family-owned business, right? So if it's obvious and disclosed that the borrower is employed by their parents or their uncle, or some type of directly related family member, then you really have to look at the guidelines, because on agency loans, for example, and conventional FHA and the like, You are not allowed to use the year to date current income on the pay stub, and you're only allowed to use the average of the last 2 years W-2s. Now, obviously, the can't average declining values comes into play. So at that point, if it's a lower 2023 than 2022, you'd be using the 2023 W-2, but you would not use the year-to-date pay stubs. But remember, this is only when the borrower is employed by a family owned by a family member, right? Um, so let's talk about solutions, right? We love solutions here at the Mortgage Calculator. Now, obviously, we're talking full doc here because remember, if we can't resolve these issues that we may have, these challenges that we may have with our W 2 wage income borrower, we have other solutions, right? A CDFI loan, which is a no income verification type loan for primary and second homes, right? Which is totally different from a DSCR, which is for an investment property only. So the CDFI option that we have is the only no income verification loan out there for primary homes. So if you have and obviously your W 2 income borrower is not a self employed borrower. Because beware, you could have borrowers that are self employed and pay themselves and a wage, but that borrower is not a W 2 borrower. When you calculate that borrower's income, you're going to use the self employed borrower income calculator. You're going to put the W 2 income as one of the income categories in that self employed borrower income calculator. And then you're going to calculate the other categories as well. So this is for a pure W 2 borrowers that are employees of somebody other than a company that they themselves are a majority owner. So, what are some of our solutions for documenting receipt of our W 2 income? Well, some of these are pretty obvious, right? Like the first one, updated pay stubs from the last 30 days to calculate the year to date income. In this scenario, you will still be required to complete a verbal verification of employment to confirm that the borrower is still employed, right? Another solution is and component of documenting the receipt of the income is W-2s from the last 2 years, but not to average them out and add to the income, but to determine if the income trend is stable. Remember, I mentioned declining income trend. How are you going to know if it's declining if you don't look at the prior year or the prior 2 years? So you definitely want to look at the W-2s to see if you have a stable income trend increasing or if it's declining. Now, our favorite tool and the one that you should probably employ as soon as you determine that you have issues in being able to document your W 2 wage income, like, the variable income is all over the place. You can't figure it out. You got those complicated pay stubs. So, again, the written verification of employment form is going to confirm the start date of the borrower. So, in case they started sometime during the year, not on January 1st, you're going to need that start date to then be able to calculate the prorated year to date earnings, right? The rate of pay is also going to be documented on the written verification of employment form. The year to date earnings, the year to date earnings of their what is considered base pay, right? This is where some of those complicated pay stubs issues can be resolved with the verification of employment because they're going to tell you this is the base pay, and that's where they're going to include all of those different categories that you didn't really know what they were. Well, they consider them base pay if they put them in there, and that's pretty cut and dry. At that point, then you're going to have overtime and you're going to have bonuses and commissions should also be broken out on this written verification of employment form. So now if you have a borrower who's been 2 years or 3 years at that employer, it's going to be nice and easy because you just get one form, they fill it out, and it's going to break out your base income and your variable income for the last 2 years plus year to date, and then you can do your averages that you need to do, which is required for all of the variable income types. And then very importantly, any promotions, any earnings increases, raises, stuff like that will be documented also in the written verification of employment form. Again, this is if it's completed by a human being, because if it's completed by the work number, they don't add any extra comments. And then you're going to have to reach out to HR for the last bullet point there is for a letter of explanation regarding the either the pay stub entries, what they are, or regarding the when was the promotion, what was the date that the earnings were increased, right? The date of the promotion, so that then you're going to have, if it's a W-2 employee that is, not commission or bonuses, then you're going to use the new higher amount off the bat. You don't have to average the prior year to date with the current year to date. If they're W 2, they're W 2. If this is base income, this is base income. And you can use 100% of the higher amount of the base income. Again, as long as it's not variable income. Because then if it's variable income, they could have gotten an increase in the percentage of commission that they get on each deal throughout the middle of the year, in the middle of the year. But that's not going to change your averages, right? That's not going to change the 2022. That's not going to change the 2023, which may be what you may have to use for your calculations. So again, note how important it is to take these matters into consideration, and how you should order that written verification of employment. And you don't have to wait till the underwriter requests it. You're analyzing the pay stubs. Borrower submitted the application. You're getting it ready to submit, and you realize, wow, no, this is all over the place here. Oh, wow, this nurse, I don't know what any of these entries are. Request a written verification of employment. Pin down the OT and the base pay and the time off, and you'll be okay. So now I'm going to break it down for you here in our last slide here, because you've been hearing me talk about year to date, year to date, year to date. So I grabbed a sample pay stub there. This is our borrower, John Doe. Year to date, he's made $900. So maybe there's a pay stub from like 1950, right, or something like that. When if this was June, and we'll calculate the income in a minute, but the income there that's going to end up calculating would have been a lot of money back then. But right now, it could be like a part-time job, right? But let's break it down. So important components here. Pay period. The pay period is June 2nd through June 16th. So Mr. Doe is getting paid twice every 2 weeks. That's 14 days. So there's going to be 26 pay periods there. We'll see if we need that. And then that's their pay rate, number of hours, all that kind of stuff. Now, he probably has started working a little bit later not on January 1st, but we don't really know that. So for the example here of the exercise, we're just going to assume that John Doe started working on January 1st, right? Because what we're really doing here is the exercise on how to calculate the base income, the income using year to date, right? So we know it's 6/16 is the pay date, right? So that's for income activity through for almost half of the month, right? So what do we do here? Well, first we determine the gross year-to-date income. In this case, $900. Now, if it was a more complicated pay stub, the borrower may have holiday that he got paid for, vacation time that they got paid for, sick days, and other paid time off. And once you confirm that that's what that is, you would add all of that income to the base pay to arrive at a total year to date. So assuming that John Doe his income. Here his income doesn't have any holiday, vacation, sick days, so we're just using 900. But if it did have other components like that, you would add it to the base pay to get the year to date adjusted with all of the earnings that aren't variable income. Then you would determine the number of months that the borrower has worked, right? So here we are 16 days into June. So 5 months have passed and 16 days, right? So we get 16 days divided by 30 days, which is the number of days in June, and that gives us 0.5333, and it repeats way out there. So depending where you want to cut it off, I cut it off at the fourth decimal point there, 0.5333. That's 16 divided by 30, and plus 5 months had already elapsed in complete months because we're in June, so that's 5 plus the 0.5333 means that we have a total of 5.5333 months that have been worked to have earned the year to date earnings of $900. So the next step, pretty elementary, right? We get the $900 year to date earnings, year to date, divide that by 5.5333, and you arrive at Mr. John Doe's monthly income of $162.65, right? So again, this is assuming that Mr. John Doe has worked the complete year, right? In this scenario here, it looks like if assuming he would have worked 50 hours, because that says this period, 50 hours times 9 is 450, then it'd be a different story. This would be his first paycheck, right? This would be his first paycheck, and then you would do the math in reverse. But usually that wouldn't be enough for us to calculate the income because we need at least 30 days worth of pay stubs to calculate the income. Right. So here, mainly this is just a training example to show you and illustrate that what we use to accurately calculate the borrower's income is the year to date figure. So please, in this example is a very simple pay stub, but please take into consideration if there's overtime. Now you're talking about needing to average the prior year or the prior 2 years overtime, the same for bonuses. The same for any commissions or any other type of variable income. So I hope everything is clear, and that you get a lot of those full doc borrowers and reach out to the mortgage calculator for your W-2 wage and income borrower loans.
All right, thank you, Jose. Looks like we do have a question here. I think we can go ahead and pull it up on the screen. The question is, when do you use the 2 year average as opposed to the year to date calculations?
Well, okay, I mentioned the one exception where you're only allowed to use the 2 year average when the borrower works for a business owned by their family, right? That's a non-arm's length transaction, and then there's going to be restrictions there of only using the 2 year average on the W-2s and not being able to use any year to date information. However, in situations other than that, you would use the 2 year average if your borrower is pure variable income, right? Not mainly base income with salary, hourly, and then maybe some variable income. So then you would have year to date for the base income that's not variable, and then depending on the loan type that you have, you would use the 1 or the 2 year. Now, for example, FHA loans are always going to require 2 years of income on all of their findings, but on conventional loans, sometimes you get a 1 year income findings. But what's going to happen is that when you tag the income in your loan operating in your loan system in your application as this is base pay, this is commission, and this is bonuses, automated underwriting is going to pick up on that, and then it's going to say, the income of this borrower needs to be documented by, and it may 9 times out of 10 ask for a 2-year finding. So I have a loan now where I have two borrowers. One borrower is commission based, actually a loan officer. The other borrower is salary, I believe, and works at a bank. So my findings required the salaried person to only provide 1 year's W-2 and 30 days worth of pay stubs, and the commission borrower, who's W-2 by the way, but he's commission, has to provide 2 years of tax returns. So you got to see what type of program. If you're going non-QM, you're going to pick your program, and you're going to go with either a 1-year income option or a 2-year income option, in which case you may be asked by underwriting to provide a letter from an accountant, for example, that that income trend is going to continue, but you would only have to provide 1 year. So you see how that works with your self-employed borrowers.
All right. So looks like another question here. Would you consider future wage increase or future bonus?
No, not exactly, but yes, in a way, right? If a person has a contract, for example, that on a job that they got hired, right? Now you do have to look at the guidelines, because they may, if they have the contract, and then you can get the verification of employment from the employer, then you may be able to make it work. But typically, bonuses or wage increases that you may get in the future, an amount that's going to be higher than an amount that's currently been earned, is going to be very difficult to document. Now, what you may be able to get in the remarks section of a written VOE, where the employer can write in some comments that it is likely, like one of the questions says, is it likely to continue, right? And then they can check yes, and then they can write some additional comments in box number 20, where they can expand on what they meant by yes. But that's yes of this current amount that may be higher than the prior amount, or maybe you don't have the 2 years, and that's what you're trying to get, that you're going to have continuity of the variable income component, so that they can even use it, because variable income needs 2 years. And this is on agency loan guidelines. If you read, for example, Fannie Mae guidelines, it says, well, we need 2 years, but we may consider 1 year, but less than 2 years. And at that point, it's those written VOEs and extra documentation from the employer that's going to allow you to capture that variable income, but not necessarily bump it up, because next year is going to be even higher. No, you're going to have to wait for next year to come about, and to be able to capture that higher income.
All right. Last question here. Do you compute variable income together with the base income and average it, or average separately then combine?
They would be done separately. So the base income isn't really going to be averaged, right? It's going to be what it is. What's going to be averaged then is the variable income.
Let's go with confirmed, right? We're confirming the base, and we're calculating the variable, right?
Correct. Yes. So the variable will be averaged, and then you add the two together. And then your application, that's where you have base pay, and then commission, overtime, bonuses, and other in the category there. The other would be stuff like automobile allowance, right?
That's the way I like to phrase it too, guys. Remember, base, we're confirming the base. That's why we're doing all the calculations, because we're going to reduce what we think is the base if our year-to-dates aren't aligning with what we think, right, Jose? It's more of confirming, and if it hits, great. If it doesn't quite hit, we're going to reduce it a little bit. It's kind of the opposite with variable, right? We have to prove every dime and average it over time, rather than just trying to make sure that it's on track, right? different things there.
All right, I don't see any more questions. So let's go ahead and wrap it up. Remember, we do this at 7 p.m. Eastern time every Tuesday, Wednesday, and Thursday evening, where we go through a new loan officer training topics. We'll be back tomorrow with a new topic, and we appreciate everybody tuning in. We'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night.